Welcome to RCLCO's February macroeconomic update. I'm Scott Bommarito, and for the next few minutes, we'll cover the latest economic developments in the United States. CPI inflation surprised on the upside in January on a month-over-month basis, as both headline and core indices rose by a little over 0.5% from December levels. On a trailing 12-month basis, headline inflation continued to moderate, falling from 3.4% at year-end to 3.1% in January. Core CPI has also moderated on an annual basis, but it has proven a little bit stickier. It held steady at 3.9% in January. More recently, core price increases have decelerated, although that trend partially reversed with January's elevated data. Core prices rose 2.7% on an annualized basis over the last 6 months, and the 3-month annualized inflation rate rose to 2.9%. If inflation remains above the Federal Reserve's target, that's driven largely by services, including housing, and if that continues for several more months, that could complicate the Federal Reserve's inflation fight right when it looks poised for imminent rate cuts. So we'll continue to keep an eye on both the CPI and the PCE inflation reports. The January jobs report was also hotter than anticipated, as it posted a preliminary estimate of over 350,000 new jobs for the month. That's the largest gain since January of last year. December growth was also revised up by over 100,000. Strong employment growth in December and January have pushed the trailing 3-month average to 290,000 new jobs per month, which is significantly above the 2010 to 2019 average of about 180,000. Economists continue to predict that job growth will cool, but so far the labor market continues to defy expectations. Job openings also ticked up moderately at year-end 2023, which is the most recent month for which data are available. Openings increased by 100,000 to just over 9 million in December, but they've slowed notably from their high of over 12 million in early 2022. In contrast, unemployment continues to hover near its record low in late 2023 and even into January of 2024. At the end of last year, there were over 1.4 job openings per unemployed worker. So that really speaks to the tightness that remains in our labor market. Strong employment growth, plentiful job openings, and low unemployment have all combined and led to higher wages, and the pace of wage growth further accelerated in January. Average hourly wages rose 4.5% over the last year, up from 4.3% growth registered in December. Over the last 3 months, wages grew at an even faster clip, increasing 5.4% on an annualized basis. So both annual and trailing 3-month wage growth exceeded annual CPI inflation, which was at 3.1% in January, representing fairly notable real wage growth. The labor market remains very tight, which is looking more like a double-edged sword in today's economic climate. On the downside, competition for workers may exert upward pressure on wages, further contributing to inflation in services particularly. This dynamic played out over the last 2 years. On the upside, however, a healthy labor market may shield the economy against a recession if the Fed keeps interest rates higher for longer. This may have played out in the second half of 2023 as the much-feared recession failed to materialize. Regardless of how employment and inflation develop over the course of the next year, consumer sentiment warmed up appreciably in January. The University of Michigan's Consumer Sentiment Survey rose 9.3 points in January, adding to December's 8.4-point increase and pushing sentiment to its highest rate since July of 2021. February's preliminary reading showed another increase, although much smaller at about 0.6 points. The index remains somewhat below its long-term average, but it has recovered from the trough of the last few years. Survey respondents reported feeling more optimistic about the economic outlook, and their fears of future inflation continued to subside. Both 1- and 5-year inflation expectations fell and converged at 2.9%, consistent with their long-term averages. So this is very good news on the inflation front, as consumers seem to be indicating that inflation expectations have not become entrenched at this point. That concludes our February macroeconomic update. Don't forget to follow us on social media for more market updates and webinars.